All right, hello and welcome back, everyone. And in today's lecture, we're going to be talking about debits and credits. Now, when people hear those words, their heads pretty much automatically go to the banking world, and they think about the difference between their debit card and their credit card. But for the purposes of accounting, I want you to wipe that all out of your mind and just know that the purpose of debits and credits is to either increase or decrease an account, and we'll talk about that a bit more in today's lecture. So the first thing I want to start with is the accounting equation, because where debits and credits come into play here is that on the asset side of the equation, a debit is going to increase an asset and a credit is going to decrease an asset. So if I obtained or gained more cash, I'm going to debit that account. In contrast, if I spent my cash, I'm going to credit that cash account. So for assets, debits will increase them and credits will decrease them. Now, generally speaking, the opposite is true on the other side of the equation. So for liabilities and equity accounts, generally speaking, debits are going to decrease the account, whereas credits are going to increase those accounts. There are some exceptions to the rule, which I've highlighted in yellow. For owner's capital and revenue, even though they're on the liability and equity side of the equation, a debit is going to increase those accounts while a credit is going to decrease those accounts. So let's dive into a few examples. So we saw this scenario in last week's lecture. So on January 1st, we've got Sherry Williams, who forms Acme Corp as the owner. She personally invests $30,000 of her own money into the company and deposits that cash in a bank account under Acme Corp. And again, the first thing we want to do is break down the scenario and identify what accounts were impacted. So if you remember from last week, we saw that the cash account was impacted because from the perspective of the business, we've gained $30,000 cash. And the owner's capital account was also impacted because Sherry now has $30,000 worth of equity in the business. And we saw how this impacted the accounting equation. Our assets went up $30,000 because cash went up, and equity also went up $30,000. Now, one of the last things that we need to do is actually journalize this transaction. So let's start with the cash account. We know that cash went up $30,000. So what we need to ask ourselves is, well, should we debit cash or should we credit cash in this example? If you remember from the previous slide, debits increase assets while credits decrease them. So since our asset account, cash, went up $30,000, we're going to debit cash for $30,000. Now, on the other side of the equation, we've got an equity account. We've got our owner's capital account. In this case, equity is going up. And again, if you remember from the last slide, in order to increase an owner's capital account, we need to credit that account. So that's why in this journal entry, we're debiting cash for $30,000 and we're crediting our owner's capital account for $30,000. And that is our transaction journalized in its entirety. Let's do one more example together. So in this example, we've got Acme Corp using $500 of cash to purchase supplies. And again, our starting point is let's break down this scenario and identify the accounts that were impacted. So the first one that we see is cash, and cash is going to be an asset account. In this case, we're spending $500, so our cash account is going down. The next thing that's occurring is that we are acquiring or increasing our supplies. And supplies are an asset account. But unlike cash, our supplies, the value of our supplies, is going up. So in this case, we've got supplies increasing. Step 2, let's look at how this impacts the accounting equation. In this case, the two accounts that were impacted are both on the asset side of the equation. So we've got our supplies going up $500 and we've got our cash going down $500. And the last thing we need to do is journalize this transaction. So let's start with our supplies account here. In this case, we've got supplies going up by $500, and supplies is an asset account. So in order to record that account going up, we're going to need to debit supplies for $500. Going on to cash, cash is also an asset account, but in this case, cash is going down by $500. So in order to record that, we're going to need to credit our cash account. So in its entirety, we're debiting supplies for $500 and we're going to credit cash for $500. One last point that's very important is just like we need to make sure that for each transaction, our assets equals liabilities plus equity, we also need to make sure that our debits equal our credits. So as you saw in the last two examples, our debits were equal to our credits, which tells us this transaction is good to go. Thanks for joining us today. For more information and more examples, feel free to visit us at easyaccounting.com.